If you want a stock that lets you actually sleep at night, not check your phone at 2 a.m., Johnson & Johnson might be your new favorite boring friend. Hey everyone, welcome back to Dividend Stock Scout. In today's episode, we're looking at Johnson & Johnson, ticker JNJ. This is one of those classic dividend names that shows up on every safe income list. But today, we're going to see if the current numbers still earn it a spot in my screen and in my portfolio. So let's start with what Johnson & Johnson actually does. So Johnson & Johnson is a global healthcare giant. They make prescription drugs, medical devices, and everyday health products. Think of the business as a three-engine plane: pharma, medtech, consumer health. If one engine hits turbulence, the other two keep the plane in the air and keep it stable and moving forward. That mix is a big reason this stock shows up in so many defensive portfolios. As of the time I'm recording this, Johnson & Johnson trades around $200 per share. The dividend yield is about 2.5 points to 2.6%, and the company has raised its dividend roughly 60 years in a row. That is dividend royalty status. The payout ratio is sitting around 50% of earnings. That means half of the profit is going to shareholders as dividends, and the other half is staying inside the business for growth, buybacks, or paying down debt. Under the hood, free cash flow is strong. We're talking around $20 billion a year, and that number has been growing again after a dip a couple years back. Price-wise, Johnson & Johnson has a nice positive trend over the last year. It's not a meme stock that doubled overnight. It's more like a steady climb backed by cash. So why might Johnson & Johnson make for a good dividend investor? First, the dividend quality. Long track record of raising a yield that's solid, even if it's not eye-popping, and a payout ratio that leaves a real cushion, nice and safe. Second, cash flow. Free cash flow, my favorite metric, easily covers the dividend. I always say, profits are opinions, cash is reality, and Johnson & Johnson just is throwing off real cash. And then third, it's its business model. Healthcare demand doesn't depend on Black Friday deals or TikTok trends. People need treatment, surgeries, and medicine in good times and in bad. So Johnson & Johnson gives you a global brand, diversified healthcare revenue, and a long history of paying shareholders. It's not exciting, and that's kind of the point. Exactly what I'm looking for. Let's pretend this is not risk-free. So first we have patent cliffs. Some of Johnson & Johnson's key drugs will lose patent protection over time. When that happens, cheaper generics step in and margins can drop. Second, we have competition. They face huge rivals like Pfizer, Merck, Eli, Lilly, AbbVie, and others. And if those companies launch better drugs, then, really, it's Johnson & Johnson could lose that market share. Third, regulation and lawsuits. This is healthcare. There's always risk, regulatory change, and potential settlements that might come through the pipeline. So yes, Johnson & Johnson is defensive, but it's not bulletproof. If I buy Johnson & Johnson for the Dividend Stock Scout portfolio, here's how I manage it. I use my standard rule, set a 20% trailing stop for my entry price. If the stock makes new highs, I move that stop up with it. Now, if the stock falls 20% off its peak while I own it, I'm out. No arguing, no maybe it'll bounce. The rule protects the downside, so a long-term hold doesn't quietly become a long-term disaster. Few things lined up at the same time. Number one, its dividend profile. More than 6 decades of raises, a reasonable yield, and a payout ratio around 50%. That combination screams sustainable. Number two, cash flow. Free cash flow is over $20 billion a year and trending higher. The dividend is not being forced, and it's backed by real money. Number three, recent results. Recent earnings showed solid revenue growth, and management even raised their full sales guidance. That tells me the business isn't just coasting, it's still growing. Number four, pipeline and deals. Johnson & Johnson is putting cash to work in areas like oncology and other growth segments. They're not just milking old products, they're trying to keep the engine running for the next decade. And number five, valuation versus stability. The stock trades in the high teens price to earnings ratio, so you're not getting a steal, but you're getting a fair price for a very high quality, very durable business. So when you put it all together, Johnson & Johnson just doesn't look like an nice old dividend name. Right now it looks like a cash-rich healthcare platform where the dividend follows the fundamentals and not the other way around. For me, Johnson & Johnson goes straight into the core defensive bucket. It diversifies away from cyclical sectors like retail, which if you see my other videos, you know I am scared of. It provides steady income, and it brings some built-in resilience if the economy hits a rough patch. So whether I buy it right now or keep it at the top of my watch list depends on what else is already in the portfolio and how much defensive exposure I want at this price. I can tell you I'm gonna buy it. All right, so that's my breakdown of Johnson & Johnson, ticker JNJ. If you own JNJ already, let me know in the comments. Are you adding it, holding it, trimming it here? What are you watching? And if you're new to the channel and you like clear, no hype breakdowns of dividend stocks, hit that like, subscribe, turn on notifications so you don't miss a future episode. And everybody, as always, thanks for watching Dividend Stock Scout, and I'll see you on the next one.